All right, let's dive in. You ever feel like the global markets are just getting yanked in two different directions at once? Well, you're not wrong. Today, we're breaking down the forecast that explains exactly why that's happening, so you can see where the real opportunities and the risks are hiding.
And really, this quote says it all. This is the single most important idea for today. Picture it like this. The entire global market is on a giant seesaw. On one end, you've got all the hope for easy money and central bank help. And on the other, you've got the very real fear of an economic slowdown. That tension, that back and forth, that's what we're digging into.
So, here's how we're going to break it all down. First, we'll define what that seesaw really is. Then we'll look at the two heavyweights, the US and China, and see how they're tilting things. After that, we'll scan the globe for other key spots, we'll touch on the crypto wildcard, and then we'll wrap it all up with a playbook you can actually use.
Okay, first up, the global seesaw. Seriously, if you get this one concept, everything else we talk about today is going to make a whole lot more sense. It's the foundation for everything.
So what exactly is this macro seesaw we're talking about? Well, it's this constant battle. On one side, you have investors getting really excited about central banks, like the US Fed, maybe cutting interest rates and pumping more money, more liquidity into the system. That tends to push asset prices up. But on the other side of the seesaw, you have these very real fears. What if inflation stays stubbornly high? What if economic growth just falls off a cliff? That fear pushes prices down. And this constant tug of war is what's creating all the volatility we're seeing.
Okay, so who are the heavyweights pushing on this seesaw? Well, that brings us right to Section 2, the two biggest players on the world stage, the United States and China. What they do has a massive impact on which way this whole thing tilts.
And this really lays out the two completely different stories, doesn't it? In the US, the main story is all about hope. The market is basically betting on the Federal Reserve to start easing up and cutting rates. But in China, it's kind of the opposite story. Their economy is weaker than everyone hoped, and now the market is looking for the government to step in and stimulate growth.
Now, there's a really important catch here. In the short term, just the hope of Fed cuts can be enough to keep stocks, especially tech stocks, chugging along. But you got to watch out for curveballs, like an inflation report that comes in too hot, or a surprisingly strong jobs number. That could send bond yields soaring and put a ton of pressure on stocks. For the rally to really have legs in the medium term, those cuts actually have to happen.
So this brings us to a really practical rule of thumb for the US market. Let's say a shocking jobs number comes out. Your first instinct might be to sell, right? But hold on. Before you do anything, look at what the bond market is doing. The real danger signal for stocks isn't just the headline number. It's a sudden, sharp spike in bond yields. That's your cue.
All right, let's flip over to China. And the picture here is, well, it's a lot more cautious. That big post-COVID rebound just hasn't been as strong as people thought. Key parts of their economy are lagging. And while we expect the government to roll out some targeted help, there's some deep structural issues, especially in the property market. Add in shaky consumer confidence, and it all points to a recovery that's going to be pretty slow and bumpy.
And this is where a lot of people get tripped up. It's so tempting to see weakness in China and think, hey, this is a buying opportunity. But that buy the dip reflex could be really risky right now. The smarter play is to wait. Wait for clear, concrete proof that government stimulus is actually working before you make any big moves. It's all about patience here.
All right, so the US and China are the two giants, but their moves create ripples absolutely everywhere. So in this section, let's zoom out and look at where else we might find some interesting opportunities or, risks to watch out for.
Let me ask you something. When you think about investing in Europe, what do you think is the biggest mental trap, the number one mistake that people make?
The answer? It's getting totally sucked into the news cycle. European political headlines can be so dramatic, but for an investor, they're mostly just noise. The smarter approach is to tune all that out and focus on the cold, hard data. We're talking about things like PMI data, which tells you what businesses are actually doing, and the minutes from the European Central Bank meetings. Bottom line, trust the economic data, not the drama.
And this table gives us a really nice quick look at some other key spots. In Japan, you've got these historic policy shifts that could finally fire up their domestic economy, making some of their exporters look interesting. Then there's India, which is just on a tear, the fastest growing major economy in the world. And Australia's market is basically a play on commodities, which means it's super sensitive to whatever happens in China. So you can see right away, it's not a one-size-fits-all game.
Okay, let's talk about the real wild card in all of this, crypto. This is a totally different kind of beast.
It's like it takes that macro seesaw and puts it on steroids. It amplifies all the hopes for easy money and all the fears of risk-off selling.
So if you're venturing into crypto, this kind of disciplined framework is absolutely key. The core idea is to have the vast majority of your allocation in the big two, Bitcoin and Ethereum. Then you can take a smaller slice for more speculative bets on other projects. And this is so important. Always keep some dry powder, some cash and stablecoins, so you have the flexibility to act when opportunities pop up.
Look, when it comes to crypto, risk management isn't just a good idea, it is everything. So here's the rule. Before you even think about buying a coin, you decide the absolute maximum you're willing to lose on it, and then you stick to that number no matter what. And those little moonshots, you have to think of them like lottery tickets. For real. Expect that money to go to zero, and if it doesn't, it's a pleasant surprise.
Okay, so we've looked at the whole landscape. We understand the seesaw. Now let's get practical. This last section is all about turning that forecast into an actual playbook.
First things first, you've got to know what could completely flip this whole seesaw on its head. These are the big risks to watch. If inflation suddenly comes roaring back, if China decides not to do any major stimulus, if some geopolitical event messes with supply chains, or if regulators suddenly decide to clamp down hard on crypto, any one of these could totally change the game.
So, with all that in mind, here's your practical checklist. Number 1, focus on how much you invest, your position size, not on trying to perfectly time the market. 2, dollar cost average into your core positions. It smooths out the ride. 3, think about hedging if you have some concentrated bets. 4, and this is crucial, hold some cash, so you can be a buyer when everyone else is panicking. 5, rebalance every quarter to stay on track. And 6, for any speculative plays, use stop losses to take the emotion out of it. See, none of this is about having a crystal ball. It's about having a solid, repeatable process.
And that really brings us back to where we started. We began with this image of a seesaw, which feels kind of passive, right? Like you're just getting tossed up and down. But when you apply these rules, when you respect position sizing, use hedges, and have your emotional rules written down beforehand, you change the whole dynamic. You're not just getting tossed around on the seesaw anymore. You're actually surfing the waves. And at the end of the day, that's what this is all about. The volatility, the up and down, it isn't going away. But your approach to it can make all the difference in the world. So the question is, are you ready to surf? Thanks for tuning in.